Hey there, my name is Ben Frazier. I am the Chief Investment Officer at Aspen Funds and very excited to share with you our new Aspen Private Credit Fund. If you're watching this video, you are either a potential capital raiser, fund manager, fund of funds, work that might consider working with us in capital raising for this fund. So we believe this fund is a very compelling offer for investors, and we've designed it to be very easy for fund managers to plug in directly with us, hit the ground running, and start raising capital right out the gate while delivering pretty compelling returns to their investors and a great strategy designed around current yield. So high yield. I'm going to get into the strategy here in a minute, but I wanted to do this quick video to just show you how we work with fund managers and how this fund is designed and how you can kind of plug in with us. If you have not yet watched our full fund webinar on how we've designed the fund, on the strategy, the opportunity, some of the case studies, examples of deals we already have locked up in the fund to close here very soon, then I encourage you to go and watch that webinar. It's in your data room here. That's a little bit longer, but it's going to give you the full framework for how this fund is designed, what the strategy is, so you understand it and can hit the ground running. And then this is really designed to help you show how we work with you as a fund manager in this fund. So I'm going to share my screen. I'm going to walk through just a short little presentation to show this how we do this with fund managers. So again, the name of the fund is Aspen Private Credit Fund. It's what we're calling an opportunistic income focused fund. Excuse me. And this is a presentation for fund of funds, how we work with y'all. If you're not familiar with us, a little bit on Aspen Funds. We've been operating funds for over 11 years. We have an impressive track record across multiple asset classes. We've raised over $200 million, almost exclusively from accredited investors. And really the past year or so, probably 2 years now, we've really made a concerted effort to work with capital raisers to plug in with us, because what we found is a lot of fund managers want to work with experienced operators and can leverage our experience, our track record for their own benefit to bring their networks into good deals that they have access to. And then you can also earn money for raising that capital compliantly in this fund to fund structure. It's a little bit on us. If you're not familiar, we have a podcast called Invest Like a Billionaire. And I encourage you to check it out so you kind of follow along with our investment themes, the education that we put out for investors. It's a very helpful tool for people to learn about passive investing in general. So I'm going to give a real quick rundown on the fund itself, how it's structured, some of the reasons why we think it's compelling. And then I'm going to get into how we work with fund managers. But before I get to that, I wanted just to give you the quick rundown of how the fund is designed and what it's going after. This is covered in much, much more detail on our full fund webinar. So if you haven't watched that, again, go back and watch that. But this is a open-ended fund that's focused on providing credit to commercial real estate properties. So there's a dislocation in the capital markets. There's for a unique opportunity for non-bank lenders to provide capital through preferred equity, mezzanine debt, and bridge loans. And so we're coming in as opportunistic capital to help support properties. And the great thing with that is if you're coming as preferred equity or mezzanine debt, you can structure your returns as a split between current pay, so current interest that's owed on a monthly basis, and then back-end profit that is owed once that project refinances or sells or takes out our position in the capital stack. And so we're really focused on that current cash yield, but also the upside through profit share. And so we're going to do that through an open-ended fund structure. And so we're going to be calculating what's called a net asset value, a NAV. You may have heard of that before. And it's basically going to be what's the share price per unit of that fund based on the income that we're generating every month, every quarter. And so we're going to publish that net asset value of the share price. And so we're obviously going to be making distributions in our current cash yield. You'll be receiving those distributions as a fund manager. And you'll also receive an account statement with a net asset value showing the value of your shares increasing from that back-end accrual of profits that have not been paid out in cash yet, but will have been earned and will be paid out once that closes. So there'll be this combination of yield plus profit. Some of the reasons to consider investing is current yield, right? In this environment, If you're investing in multifamily kind of value add projects or other verticals that are more focused on growth or long-term payout, current yield is something that a lot of investors may not be accustomed to or even realize is possible. And so the focus of this fund is delivering current yield plus that profit and create this passive cash flow stream. The way we're doing this is in preferred positions in the capital stack. So our fund investments will be in preferred positions, either through preferred equity, where we have priority over common equity, mezzanine debt, which has priority over any equity investing in the capital stack, and then also bridge positions, which would be first or second position, secured loans secured by the real estate, usually short-term in nature. Again, this is an open-ended fund structure. So we will have a net asset value that's going to be growing over time. We're going to be sending out distributions, and we also will have liquidity. So because it's open-ended fund, we're going to be offering liquidity to investors after about a 2-year lockup period with a 90-day notice. So it's not guaranteed liquidity. It's what we call best efforts liquidity. So as the fund has internal payoffs, as we have these short-term loans pay off, long-term loans pay off, we'll have liquidity of cash kind of coming in, and so we can help meet those redemption needs also for your investors. So you can offer that to your investors. Strong sponsor team. We've been actually operating open-ended debt funds for 10 years and have a lot of experience doing this. So this is just a very natural kind of new fund for us to add to our mix and really make it designed for fund managers. We're investing alongside of all of our investors. So Aspen Funds Management Team, I have one of 4 partners. All 4 of us put our own personal cash into this fund, and we'll continue to invest in it over a long period of time. It's going to be a diversified portfolio. So instead of investing in one project, one development deal, one value add deal, one property, investing in a fund, your investors are going to get the benefit of diversification into multiple projects, multiple markets, multiple operators. And that fund, as it grows, that diversification will also grow too. Here's a quick overview of the fund, how it works. Basically, you start earning your preferred return, which I'll show what those are in a minute, after 3 months. And then that's paid monthly as cash is available. So it's not guaranteed you're going to hit that preferred return every month, but that's the goal. And we expect to hit that most of the time. And we have profit share that's going to be paid every quarter or as available after 3 months. We also allow compounding. So if investors want to compound, if your investors want to compound, you can grow at a faster rate by buying more units every quarter in the fund and reinvesting those earnings into new units. This is an open-ended fund, so we're going to bring in capital in tranches. We're going to be not just taking capital at will, though we have strong deal flow. We will bring in a lot of capital, and I'll talk about more of that in a minute of how we're going to work with fund of funds in that regard. Investor protection. This is a non-dilutive fund, so new capital is being brought in to produce, to purchase or make investments or loans into producing assets. We have a high watermark, so Aspen cannot receive our carried interest, our profit split in the fund unless the unit price per share increases and is exceeding the highest 12-month price before. So basically, if there's a loss in the portfolio, if NAV decreases for some unforeseen reason, we can't take our carried interest until investors are brought back up to the highest share point in the past 12 months. So that's just a protection to where we're not going to make money if the values go down, right? And that creates full alignment of interests all across the board. Very, very powerful concept. We can talk more about that if you like. If you have questions, reach out to our team. We can explain how that's of value to your investors. Returns and reporting. These would be monthly preferred returns, quarterly profit share, account statements. Fund reporting will be produced quarterly. We'll be producing all that to you as fund managers to share with your investors with your own branding, and you can put your own things that you want to put on there to make it coming directly from you. Again, like I mentioned, we have liquidity options. So this is a very great concept for people. And a lot of times you're working with investors trying to close them. Liquidity is a very powerful idea, right? Because if someone's just meeting you and they want to invest in a deal, but it's a 5-year lockup, a 7-year lockup, 10-year lockup. We have funds that are 10-year lockups. That can be hard for someone that's just meeting you to make that commitment for that long of a time. 2 years is not that long. And so this can be a helpful way for you to bring in more capital because it's a way for you to build that relationship, build that trust, and ultimately, hopefully, raise more capital over time. We are going to get an annual CPA audit. So this fund will be audited from the get-go. So you'll be able to have access to all those audit reports for just, assurance of quality of the financial statements, assurance of how the NAV is being calculated, et cetera, et cetera. We will be taking IRA investors. So as you have IRA investors, we can work with those folks. And let's get to fund of funds. Okay. Here's our share classes. So we have 3 share classes in this fund. Again, this is in the full video, so I explained that a little bit more, but the share class we've designed for you, especially fund managers, is Class B. So we have a minimum of $1 million to invest in that share class. You can see here there's a 1% increase in preferred return. There's a better profit split. It's 80% profit to the LP versus 70%. And there's also lower AUM fees, and there's also lower origination fees. So all those fees basically gross up the yield being sent to the Class B members. And then you can basically take your spread off that. I'm going to show you in another video that's in this data room of how our fund-to-fund calculator works, so you can estimate kind of some what you can expect to earn raising for this fund. We have a Class C share. This is also available for fund of funds. So we have some larger fund managers that are, potentially raising for us in the Class C category. So if you think you can hit 5 million, the numbers only get better. You'll just make more money. Better splits, better preferred return, and lower fees as well. So that way you can earn even more and still send that to your investors a nice yield. So like I said, this is our exclusive share class for fund of funds. Some of the things to consider is you're finding a partner to work with, right? You want to work with somebody that knows how to work with fund of funds. We've been doing this for several years, as I mentioned. We have a lot of fund managers that work with us, and we're looking to bring on a lot more over the next couple of years. And from your benefit, you get to partner with an experienced, well-capitalized operator. We've been doing a lot of funds for a long time. We have 4 partners that are involved in the business, and we've built a great track record, and we're well capitalized. So that's just gives some confidence to you that you can go out and raise with us and not be worried about confidence in track record, performance, execution, et cetera. Your investors are going to earn double-digit yields. So the Class B yields are the gross yields to your fund. I'll show you in the next video on the fund of fund calculator how much your investors can earn after you take your cut. But it's still great, strong yields. And again, there's kind of total yield plus cash on cash yield. So the double digits will be total yield. It's possible that the cash on cash yield could be double digits, but it's probably that high single digits, low double digits cash yield. But the total return, which includes cash plus the profit share through the NAV calculations, will be in that double digit range. Instant diversification with one investment, and we help you hit the ground running and get all the marketing materials reporting that you need. Here's some of the benefits of operating an open-ended fund. And so a lot of people that are raising capital, you possibly included, have not raised for an open-ended fund before. And it's a different concept than what you've been used to if you've just been raising for syndications or closed-end funds. And what we've found as Aspen, running open-ended funds for over 10 years, there's some extraordinary value in doing this. And I'm going to share some of these things and why it's so valuable. One, you always have an open offering for investors, right? And so when you're meeting people and you're building those relationships, sometimes you might not have a deal, but sometimes people have cash and they want to deploy that cash right away. So this is a great way to be able to raise more capital because you always have something available. And so what we found is you can kind of just set it and forget it and kind of keep doing your marketing pushes every so often. We have a new deal coming, and you can just continue to raise more capital and build on that open-ended fund. And it's been really, honestly, easy to have an open-ended fund over the course of time, and you just raise more money doing that. And then you can also be raising it alongside of other deals. So you're raising for this fund, and then you're also raising for another fund. You don't have to turn this fund off. You can, what we do all the time. We have multiple offerings that are open at the same time. Hey, investor, ABC, we've got two available offerings right now. We have an income-focused fund. We have a growth-focused fund. How about you put a little bit in both and you can spread out your risk, you can spread out your strategy. And the great thing is these investors, if they're accredited, they have cash to deploy. And if you have multiple offerings, you can pull out more cash from that same investor, because you have things that are complementary to each other and you have multiple things open at once. We do this all the time. It's one of the fastest and easiest ways to raise more money from the same investors is to have more options. Another big benefit is you build investor confidence quicker with immediate cash flow. Think about this. When an investor comes in, they've gone up the trust curve. They decide, hey, you're trustworthy. Your operator is trustworthy. I'm gonna dip my toe in the water. So they send you a check, say for $50,000. Well, if they're accredited, they've got a lot more than $50,000 that they can invest, but they want to build that relationship. What we've seen is when you start sending checks back to people and they're earning their interest and their yields, in a cash flowing fund pretty quickly. That is such a powerful confidence booster that makes them confident wanting to invest more with you, right? I know a lot of investors say, I'm not going to invest until I see that first check. Well, if you're in a deal, it's a development deal or a value add deal, and there's just no distributions for several years, that's a long sales cycle to wait for that next check. But if you can get them a check in the first 3 months, then all of a sudden that confidence goes up and you can leverage that to raise more capital from your same investors faster, shorten that sales cycle, shorten the sales cycle. From your standpoint, this is a huge deal. This is a huge, huge deal. Fund managers get paid consistent income versus mostly back end profit on deals that, hey, may not actually hit pro forma. Let's just be real. There's a lot of challenges in certain deals, especially maybe deals you've raised for in the past that may not hit pro forma. And what I've seen, you can get excited about the back end numbers of what you could raise, for a deal. But if that deal doesn't hit pro forma, you've waited now, say 3 to 5 years to kind of get that first meaningful payout. And all of a sudden the deal that hit pro forma and what you were expecting to get got cut in half or got cut in, 3/4. And now all that work you've been waiting for this whole time, it wasn't actually as meaningful as you thought it was going to be versus getting consistent payouts on a monthly or quarterly basis that you can use to build a consistent income stream for you to continue to build your business raising capital. Here's the biggest challenge as a capital raiser that you have. If you're just going capital raise, you're not operations, you need income to support your business while you're building that investor base, while you are trying to build that equity in deals over time, right? It can be hard to have the income from those deals support your lifestyle, support your business. And so this is a great way to just balance out some of your portfolio from a fund manager standpoint to start getting more consistent income sooner. The other benefit here is you don't need to hit the $1 million right out the gate, although we love if you do, but we're going to give you a little bit more time to hit that $1 million, right? So the raise period is longer because it's an open-ended fund, so you can build your momentum over time into this, and you can actually raise a lot more over multiple years if you like, than just the $1 million. So that's the great thing with this. You can just keep adding to it. How do we work with fund managers? We try to make it as simple as possible for you to hit the ground running. If you haven't worked with us before, here's kind of some things we do. Like I said earlier, we provide all the marketing materials, all the reporting that you need to send to your investors. You can rebrand it on your own templates. On the upfront setup, we pay a portion of your legal fees. And we've actually negotiated some deals with some attorneys and some portals that actually help get you plugged in. They're already familiar with our fund, already familiar with our process. And we're going to pay a portion of those fees so that your upfront costs are reduced so that you can start earning more cash sooner. What we've done on our fund at the Aspen level to our retail investors is we have our minimum investment at $100,000. So our other income fund is a $50,000 minimum. And what we did on this fund is increase that to 100 because we want you to be able to have flexibility in what you can offer your investors. So a lot of fund managers we've been talking to, a $50,000 check is a great size. And if you can offer to your investors, hey, if you come into my fund, you can come up with a lower minimum. You can reduce your minimum to lower if you want, but 50,000 I think is a good number. At $50,000, your investors can come in and get access to this fund through your fund, where they would have to write at least $100,000 check if they're coming directly to me. The other thing that's going to be a challenge for an investor coming direct to me is we're going to prioritize fund to funds when we're bringing in capital in tranches. So Every quarter, we're going to be looking at the deal flow that we have coming up. We're going to be kind of sizing up how much capital we need. And then before we go to market to our retail investors, which is a pretty big retail base, we're actually going to go to fund of funds first because we want to prioritize you to help you get the off the ground, get the capital you need in the door. And we're going to give you that option to reserve those spots before we go to our retail investors. So your pitch to your investor is, because I'm a fund manager, I've been working with Aspen for a little bit of time, assuming you've been doing this for a couple quarters or whatever, I get access to the fund when there's capital availability before retail investors. If you go straight to Aspen, you might have to go on a wait list. Whereas if you come through me, I get that early access because they work with fund managers first. So that's a very powerful concept in establishing your value as a fund manager. That's it. Next steps, you're already in the data room, so you can see, we love for you to submit a soft commitment. We are going to be limiting the amount of commitments we take in initially to kind of work with the first kind of batch of fund managers, and then we'll let more in over time. But we do have limited deal flow right now, and we're building that up. We have a lot of good deals, but we actually have a lot of interest that we didn't even anticipate from retail investors. So there's going to be limited spots. So if you are interested, please submit a soft commitment. Let us know how much you think you can raise. Really in a 6-month period is probably what we're kind of thinking. And then obviously over that time period, you can raise more, but you really want to hope you can hit that $1 million in say about a 6-month period. And we'll work with you. We'll be flexible, but the $1 million is really what we want to shoot for. So email us at investorrelations@aspenfunds.us. If you're already talking with Mike or Ben or someone else on our team, reach out directly to them. Let them know you put in a commitment. You're ready to go to the next steps, and we'll take it from there. Thanks so much for watching the video, and hope this was helpful, and we really appreciate getting to work with you if you think it's a good fit. So with that, watch the rest of the videos in this portal, digest all the other information. If you haven't watched the fund to fund calculator video, feel free to watch that next. I'm going to show you how the actual fund to fund calculator works and how you can use it to estimate what your target profits might be as a fund manager raising for this fund. Thanks so much.